All right, guys. Bang, bang. Jeremy's here. Super excited about this. Thank you so much for coming. We got a lot to talk about today because you come from the non-crypto world into the crypto world. Let's start with background first. You started out doing everyone's favorite activity. Tell us what got you started.
All right. Well, first, thanks for having me. I'm really excited to be here. Background-wise, I started as an auditor after getting a degree in accounting, and discovered in about 6 months that I hated it. But
It took you till after the degree to figure out you hated
as bad as that sounds, I guess I was naive. I was pretty good at it in school, and it just didn't really dawn on me that I wouldn't enjoy it after I got out of school, because the school life and the actual career life are pretty different.
When you talk being an auditor, are you like flying to the location? You're locked in the room that they've turned the AC up really high to get you out of there quickly?
Yeah, more or less. I mean, it was all in the Dallas-Fort Worth Metroplex
Okay.
area, so not really on the in airports for that, but it was insurance companies, and very much in the darkest corner of wherever they could put you. Very much stereotypical.
Hope that your calculator ran out of batteries or something, right?
Yeah.
All right, so you did that and then figured out maybe you wanted to do something else. What did you do next?
Yeah, I wanted to get on the right side of the income statement. I was keenly aware that no matter what I would do with my career, I was always going to be an expense, and I wanted to get on the revenue producing side. I actually took a position to open an office in Austin for a small third-party administrator which runs corporate health plans. So larger companies would partially self-fund and kind of create their own health insurance products. It was a really interesting B2B application of the insurance world, and launched an office for them in Austin, and had a lot of fun doing it, and did well.
All right, and so how do you go from doing that to managing the wealth of what I think we've already dubbed as poor rich people?
Yeah.
Before we started recording.
Yeah, hopefully my clients aren't listening to this and won't hear me lovingly refer to them as poor rich people. But I kind of reached a point in my insurance world where I had saturated the market. We had really conquered it, and there wasn't much for me to do. And that's a really bad place for me. I can't be bored. Mm-hmm. And so I just started looking around and thought, well, I'll laterally transition out of the insurance world into the money game. And I started as a rookie broker, second career-wise, and at A.G. Edwards in Austin in the year 2000, just in time for the dot-com
Man,
bubble.
you ran right into the teeth.
Perfect timing.
What was it like? So .com crash happens. It seems like the world's on fire. What's going on inside the company?
You're second guessing yourself, number one, from walking away from really good money to start over. But from a money perspective, it actually wasn't that bad, because it's hard enough to convince somebody to let you manage their money when the world is good. You'd think it would be harder when times are bad, but not so much. People get insecure about what they're doing, and they're actually more willing to listen. So ironically, even though it sounds like that would be a hard time, it was perhaps maybe an easier time.
Yeah, it's interesting. It's like the human psychology of, what do I need you for? The market just went up 30%.
Right.
You're going to beat that.
Yeah.
Versus, hey, the market just went down 30%.
Now I'm listening. Now I'm listening. Yeah.
For sure. And so after you go through the first kind of teeth of a bear market, you ended up actually going through a second one.
Yeah. So halfway in the middle there, we left the firm and started our own. I had a partner, and so we were kind of entrepreneurial already. Wanted to launch out on our own, and then we went through the Great Recession, and that one hurt more, obviously, because by that time I was somewhat successful, had clients. I could swing hard in the dot-com bubble, and I didn't have any money that I was actually responsible for, so I didn't have to apologize. But so that was harder, and I actually came out of that fairly disillusioned. It was kind of at a crossroads where I thought, I'm either going to leave this business or find another way to do it.
Mm-hmm. And why a different way to do it? What was like the kind of warning signs?
I had begun to dabble in alternative investments. Even the largest brokerage houses on Wall Street have, silos of alternative investments. And it was, for whatever reason, I was just naturally drawn to that. Mm-hmm. But I knew that it was, dull, boring spoons. It wasn't, you cannot provide big legions of advisors in the Merrill Lynches of the world, the UBSs of the world, with sharp instruments where they can hurt themselves. No, in other words, it's about capacity. If you can't ingest $100 million of new capital a month into your strategy, you can't be on a big platform. Mm-hmm. So that kind of takes away the inherent positive idiosyncratic risk profiles of what that entire asset class was designed for.
Yeah. And so how do you go from there's a different way to do this that might be interesting to actually know how to do it, right?
Yeah.
It's a pretty big learning curve, it would seem like.
Huge learning curve. Basically, I sort of decided that people with real money, $100 million plus money, probably weren't managing money the way that I was. And I didn't know how. I didn't know how to figure that out. But I set about trying to network into the family office world. And you got to understand, the family office world doesn't hire brokers or advisors. They put people on payroll in their office. Mm-hmm. And so those two worlds are pretty exclusive. They don't usually find a way to connect. And so, but I had a connection. There was a family office in Chicago worth $100 million and another one worth $150. And they were patriarchs of families whose children were now adults, and they were seeking to empower the second generation of wealth to kind of crystallize a business around taking that $250 million and inviting other really wealthy families to join them in the classic multifamily office sense of the word. But they'd never done it before. I, on the other hand, had launched my own advisory firm twice and knew how to interface with the regulators. So I kind of talked my way into a job as their chief compliance and chief operating officer in exchange for a seat at their investment table, which was just a total blast. For 4 years, every time they got on an airplane, I went with them and learned all about, hedge fund investing, private equity direct deals, real estate direct deals, venture capital. It became the education that I needed on which to form the center of my current practice.
Well, there's two pieces here, right? So the first is that there's a big difference in the mentality and kind of the practice of investing depending on the capital pool. So if you're kind of an everyday American, right, the bottom 50% of Americans don't have any money to invest at all, right? They're living paycheck to paycheck, can't come up with $400, $500 emergency payment. They're obviously in a very different situation than everyone else the other 50% that have capital to invest. But inside of that, I have capital to invest bucket. You get the people who really probably have enough capital to put into the S&P and kind of more passively invest. Yeah. Then you get, what I lovingly described as like the poor rich people, which is, kind of $20 million or less, which sounds like a lot of money to everybody, right? Mm-hmm. But when you start to look at how do you invest in all these multiple asset classes? Well, many of these asset classes, you can't actually get exposure to them without putting $1 to $5 million. Yeah. And so if, you got to put $5 million in real estate, you got to put $5 million in stocks, you got to put $5 million in bonds, you got to put $5 million in fixed income, you get on the line, you run out of $20 million pretty quickly. And so you actually don't have the capital pool to invest like a big institution would. But I think what you're talking about is these family offices that usually it's some sort of generational wealth, right, that they've created either through a business they own or inheritance or whatever. They can invest like an institution, right? They're essentially a small institution. And so the ability to put millions of dollars into each strategy and build kind of a diversified portfolio is available to them. And so it's that mindset shift or change that sounds like you really went to go see, like, how do I learn that?
Yeah, there's a lot to unpacking what you just said, and it's really a passion point for me. The laws that regulate the quote-unquote private placement world haven't been changed in decades. I mean, 1940, the Advisors Act was really the last major piece of legislation that governs how to qualify for participating in private placement deals. So it's kind of interesting that $100 million families very often create product that is really just meant for an accredited investor, which you and I both know means you got $1 million basically, with a couple other caveats. But they've got $100 million, right? Well, they only need 100. You only get 100 slots in an accredited product. Well, they don't need 100 slots. So ironically, they're creating product with 100 slots for 10 or 15 of their friends, and there's all this room on the backside. So if you figure out how to plug into that deal flow network, and you respect them and you ask good questions and you get on airplanes and you go visit them and you're interested in their projects, you don't actually always have to put $1 to $5 million in these deals. As an advisor, I represent 20-ish families, and my capital commitment to that deal is meaningful to them, even though at a ticket level it's very often 100,000 or 250s. So it's what I discovered in that regulatory framework that allows me to go port that $100 million thinking down to this $5 to $25 million world in a very compelling way that it doesn't seem like it should work.
Yeah, and I think the other piece of this is not only how they think about it, but also you, in an effort to go learn, did probably the most important thing people can do, which is you went and surrounded yourself with people doing what you wanted to do.
Yeah.
Right? And I get young kids who, especially like right out of college, who write to me all the time and say, "Hey, I want to do X. What's your advice?" And I always tell them, I say, "Look, first of all, you shouldn't be asking me for advice because I don't know your situation, right? Some random guy and you're some random guy. So how do I give you advice? I don't really know." But one piece of advice that ends up working, regardless of who you are, what you want to go do, etc., is just go find people who've already done it.
Yeah,
right, and they'll teach you.
I tell my kids, and I try to practice this myself. It doesn't help you to be the smartest guy in the room. In fact, rather, you really need to find a way to be the dumbest guy in the smartest room, because there's upside there. No upside to being the smartest guy in the room.
For sure. So you go for 4 years or so, and you're kind of getting this crash course. Any like really, really special deals that stick out in your mind as like it was kind of just a crash course in the type of investing or something that you knew nothing about that you got up to speed really quickly on?
Oh, I don't know that I could pick one out particularly. We did a number of hedge fund deals early, and maybe I can kind of bifurcate them into two different worlds. One of them was coming to grips with $100 million wealth being okay with a 5% return in a market neutral strategy that was supposed to get 10 but somehow always got 5. My clients didn't like that. So there was I had to make a shift to understand $25 million absolutely does not think like $100 million. But on
specifically around the return profile.
Oh, for sure.
Yeah.
I mean, if you make 5% on $100 million, life's going to be okay.
Yeah.
People don't actually, even though it's true in some sense of where people don't actually feel that way with 25 as much, not anywhere near as much. But at a deal level, to be more specific to your question, we did put some money in a structured product deal right around the Big Short deal with the mortgage blow-up deal, and that was fun to watch. It was really fun to find a thesis that was contrarian to very complicated product, to get your head wrapped around it, find enough confidence to put an allocation in, and then just watch it take off.
Yeah,
those are always fun.
Yeah, and what you're talking about there around that return profile, right? Is there's a very offensive and defensive mindset difference between 25 million and less and 100 million and more. And this sounds absolutely insane to anyone who is a normal American, right? The average American's like, what are you talking about?
Yeah.
But, and I've gotten this crash course over the last 2 years or so going and talking to a lot of these family offices, et cetera. There's a very big difference. That $25 million family wants to be the $100 million family, right? It's the keeping up with the Joneses in a, on steroids, basically.
Yeah.
The $100 million plus family actually understands, I got $100 million, right? Like, I want to keep the wealth I have. And so there's a offensive versus defensive mindset. And you would think that for the everyday American, hey, if I got $25 million, I'm protecting the hell out of that, right? But it's just they slowly go from they have nothing to they have $1 million to $5 million to 10 to 25, and they still are looking up saying, how do I get to 100? How do I get to more?
Yeah, so I have a theory or two about that. You can have a good career and cobble together $1 million, $2 million, $3 million bucks. But if you get multiple tens of millions, you did something special. And normally, people that do something special have a really strong type A conquer the world mentality. They're taking entrepreneurial risk. They're doing something risky. And it is about the wealth generation. People do end up at 100, but sometimes that guy, he's the guy who went from 2 million to 25 and now he's at 100. But at some point along the way, he retires. And it actually becomes more about the psychology of generational shifts, where the second generation doesn't have that. and in fact they know they don't have it, and so it's more of protect and preserve. So there's a couple of there's no stereotypical thing. Every family is different, but these are generational shifts and sort of wealth accumulation shifts that kind of happen in my experience.
Yeah. One of the most powerful things somebody said to me early in life was they said, $1 million is a lot of money, right? And I was like, of course, right? I was, 18-year-old kid. I was like, Jesus Christ, $1 million. Like, I'd do anything for that, right? Yeah. And they said, if you're a teacher in most places, right? And let's say you earn somewhere between $40,000-$50,000 a year, right? Yeah. Which is probably an average salary. If you work for 20 years, you made $1 million, right? Yeah. Now there's taxes, you got expenses, all this kind of stuff, but it is achievable if there's a long enough time frame, right? And so what he basically was explaining to me was like, look, $1 million is a lot of money in short bursts, right? If you make $1 million in a year, if you sell something, make $1 million, whatever. But over a long enough period of time, even if the salary level is low, you can accumulate top line dollars. Yep. But there's taxes, and what's your expense ratio, right? If you make $50,000 but you spend $60,000, well, you're not going to keep anything, right? Yeah. But if you make $50,000 and you spend $10,000, actually, 25 years later, you have $1 million.
I can remember being a sophomore in college thinking, when I'm out of this place in a few years, if I could just make $65,000 a year, life's going to be great. Yeah. Life's changed.
It's and it's for multiple reasons, right? There's the inflation, right? So everything around you continues to get more expensive, but also there is this element of you don't expect the expenses that you have, as you get older, right? You get a family, you get a house, kind of all college. These things, right? So it's really interesting. All right, so let's talk about kind of after you got that crash course, right? You spent 4 years going and seeing all these things. What did you change in terms of how you worked with your clients on the wealth management side? So they don't have $100 million, but they're kind of in that $5 to $25 million range, et cetera. What was the general, change that you saw, or how did you talk to them differently?
It really was. There are a small hand, maybe I'd have to think about them, 3, 4, 5 clients that are holdovers. That cross that bridge. So it was actually more
from 100 to 25.
Well, no. That I'm saying people that were my clients in the old world that migrated with me. So it was actually more of a turning over of my business. It was a shift. It was a shift in who
you wanted to work with.
Who I wanted to work with.
Interesting. Explain
or who would work with me.
Okay.
Who would want
explain
to work
that more.
You just start. People tap out, right? I think the bond market today, with a 2 handle, pretty unattractive place to try to collect a yield. Do I like tax liens? Where there's some really sharp tax lien strategies you can clip in a really conservative way, 6, 7, 8, 9% a year, with a really secure piece of real estate backing you up, right? Why wouldn't I do that? Mm-hmm. Like, you have to take liquidity risk. You don't have. It's obviously not as liquid, but if you're wealthy enough to have that much capital, you don't need the liquidity. Right, so it's a shift from normal, traditional, modern portfolio theory, 60-40 stock bond allocation thinking to, no, we're going to think different, and we're going to really evaluate risk differently. We're going to stop trying to pay attention to correlation matrices across large time frames, and start paying attention to what happens to correlation matrices when everything blows up, because that's really the only time it matters. Nobody cares about correlation when everything's good, just when it goes down.
All right, so this is important because I don't think a lot of people think about that nuance. Explain in more depth why that is. Like, why should people care about the correlation on the downsides or in the bad cases, and not so much on the upside?
Well, because everything's the whole point of diversification is to protect your capital in negative events. Right? There is no other reason to. If there were never any negative events, you wouldn't need to diversify. You would just be long everything, and it would always go up. So the question then becomes, well, if I think that investment A and investment B have a not very strong correlation, and I project that across all time frames, whether the market's going up, whether it's sideways, or whether it's going down, I may miss the fact that, in fact, it might be positively correlated in a rising market, but strongly negatively correlated in a falling market or vice versa. And invariably, what we see is in a capitalist world system, in a capitalist system that we have here in this country, you have everything connects to everything else. The high yield bond market connects to the equity market. The globalization means the international markets connect to the U.S. markets. The growth and value investors both get their head handed to them when profits go down and people start paying less per profit dollar on the S&P. And so that's when it matters. It only matters. And the more crazy things we do in monetary policy to try to manipulate that game, the harder things adjust when we no longer can.
Yeah, and I mean, it's pretty clear that's what's going on, right? Is every time we start to get towards these negative moments, central banks do two things, right? They cut the interest rates and they start printing money. And it seems like now we've entered a world where the cutting of interest rates is pretty well understood. There's lots of speculation on what they're going to do, at each decision point. But the printing of money, it's no longer are they going to do it, right? It's pretty much, look, we're addicted to this, and we're going to have to keep some rate of inflating the monetary supply in order to keep kind of this train going, because if they stop, it's going to get ugly pretty quickly.
Yeah, I'm not afraid or averse to taking directional market risk, but what I'm saying is to have safety in your portfolio. There is no real safe assets, in my opinion, in most traditional markets. You have to go find a tax lien investment or a life settlements investment or private debt deals. We love what we call the Pawnshop business model, where you go lend somebody money. I don't care whether you pay me back or not. Your collateral is worth, I'll take your collateral and I'll make my money on your collateral, or you'll pay me back. And there's all kinds of investment opportunities like that. If you do your research, you can clip near double-digit yields in a portfolio.
Explain. Can you give me like an example of one of those? Because I think the private credit space is one that we've spent the least amount of time talking about here.
Sure.
But I've got a very good friend who runs a shop, and that's been one of their main focuses recently is private credit. And I'm personally fascinated by, if you find the right opportunities, it can be quite lucrative.
Sure. It's, so let's say you've got a, I'm just trying to think of a deal. Give me a second here.
Surprising, I'm asking them for deals right now. Come on, help me out with the deal flow.
You got a multifamily project in a good market. Call it. I'm making this up, but it's representative. Like in a market like Austin, Texas. We love Austin. Austin's got really great
demographics.
Oh yeah, it's huge. And so you got a deal in Austin. It's poorly managed. It's half full. The owner of the property has got deferred maintenance. He's been living off of the rents that he should have been pouring back into the property. It's starting to circle the drain. You can tell it's, he's going to have to hand the keys back to the bank, right? Some other developer comes along and he finds it's a value add play. It's a classic real estate value add play. He buys the dirt really cheap out of foreclosure, bankruptcy, foreclosure, and he capitalizes his deal appropriately, fixes the deferred maintenance, gets it pretty again, and re-tenants it, right? And so you go from half full to full. And so there's two ways to win on that. There's the entrepreneurial equity side, where you're not going to cover off the ball if you actually execute, but you can also win on that deal by being the debt guy. Mm-hmm. Like, I'm going to give you 50 cents on the dollar. I mean, if you're depending on the cap rate you buy it, there's a way to conservatively lend money on that deal, so that as the senior lender, if he screws up, you take the keys. Mm-hmm. So as long as you lend it for a dollar that is at or below fire sale prices, mm-hmm. so that that in 24 hours you can get rid of the property and get your money back, that's a really strong, compelling, asymmetric risk return profile. I get my capital back in the worst case event. I get my capital back plus typically 10-12% interest if I'm right.
Yeah. The part to me that, as I've spent more time with folks in the family office world, that I don't think I really understood in pretty much every game you play in life, right? What you want to do is you want to stack the deck in your favor, mm-hmm. right? So what that means is I'm going to try to figure out pieces of information before other people. I'm going to try to find something other people can't find, right? I'm going to have a strategy that no one else understands, all these different things. And that's true in sports. That's true in board games, whatever. That's what family offices, especially the wealthy ones, are doing in private investing.
Yeah,
right?
I'll tell you a deal just because I'm thinking about it as you're saying it. But this is an actual real live deal that I'm doing in Austin.
Can I get in?
No, please, nobody call on this because it's actually fully capitalized. There's no more room. But basically,
you guys see me using the podcast for deal flow there.
No,
my real strategy has been revealed.
No, it's an RV park. So in Austin, there's such a dearth of workforce housing. There's just not enough supply. Cannot keep up with the demand. People are living full time in RV parks. I didn't believe it at first, but when I heard that, I literally booked a flight, went to Austin, and walked to the parks to go figure. And it's unbelievable to me.
These are like what? Like tech workers? These are more like blue collar jobs?
It's
a combination?
both. It's both because there's also this kind of fire, financially independent, retire early, minimalistic, millennial ethic, the tiny home movement. That's all big in Austin as well. So you could have an $80,000 tiny home sitting on a pad next to a $5,000 used, pop-up trailer.
Yeah,
and
fascinating.
It's really fascinating. Well, we basically bought 30 acres of dirt on the edge of Austin, and we're developing a new RV park. And it's really hard to get the permitting entitlement done correctly. But basically, if you do, you can create, a really interesting gated community with curbed streets and not a blight on the community, and provide on 30 acres 300 housing units for this workforce housing, and the economics are incredible. It's $600 to $700 a month for the dirt rental per pad.
Yeah. What's crazy about this? So I know somebody who did this with mobile homes. Now they didn't buy the dirt; they bought the actual mobile homes themselves and rented them out. One of the things that I had never thought of until I actually went and saw what they were doing is how much more dense the acreage can be when you're renting it out, right? It's kind of like what the WeWork model was.
Yeah.
Now WeWork went in and took a big space and then cut it up, right, and then rented it out in little slices and made they were supposed to make some upside or net something there on doing that. Same model here. You go buy 30 acres, right? When you cut that up, if each piece is on a per dollar basis higher when you rent it out cut up, you're going to make money. Right?
Yeah, we're going to stabilize this project. We're expecting to break ground late summer, but it's about 6 to 9 months in construction time to get it on to get the infrastructure laid. But we expect to stabilize it at mid-teens cap rate and compress into a sale at 8, which is a fancy way of saying we think we can turn $10 million into 20 in a 3-year period of time. And the upside is compelling. The downside is pretty minimal. I mean, the dirt is on the edge of Austin. It's on a killer corner in a really busy place, and so if I don't get the right to build the park, I can sell the land today for more than I bought it. So we love those asymmetries.
Yeah, and part of this too is you're talking about doubling your money, right? Well, we'll get to crypto in a second. But to most people in crypto, doubling your money doesn't sound that great, right? But you're talking about combining upside with risk profile, and in that risk profile, the part that you also hinted at that I think a lot of people don't understand is when you have wealth like many of these families do, time's on their side. So if they buy that piece of property and all of a sudden markets crash, prices go down, they don't get the approvals to build, etc., the worst case scenario is they left holding it.
We become a land bank on a really good piece of dirt in one of the best markets in the country.
And 5 to 10 years from now, it'll be worth 2 to 3x anyways.
Yeah.
Right. And so it really comes down to what those liquidity needs are, and kind of what the appetite is to the investor. And I think that's one of the things that the public markets probably don't provide. Right. Just given there's daily price.
Yeah.
Lots of volatility. They got television shows talking about it. Right. They've got newspaper headlines. Like all this stuff's going on, and it's very easy for people to get in their own way and make emotional decisions. But in these private markets, it's a little bit harder to do just given the nature of the assets.
Yeah, I think real risk management, and this is just me talking, but it really comes down to what's your upside, downside, and what's the probability of those outcomes. Right? If I have a upside of 2x and a downside of break even, you take that bet all the time, right? If I have an upside of 2x and a downside of lose everything, I better be right more than half the time, or I'm not making money. Right? So that's why even something as crazy aggressive as crypto is compelling, because there's a small right tail risk exposure, 2 to 5%. It can go to 0. I'm okay with that for the trade of it going 20 to 100x. I mean, I'm making that number up, but it's if you have enough upside and you can throw that bet enough times, you're going to compound capital.
Yeah, the numbers over the last 5 years, and these numbers are a couple of months old, so just generally this was correct. Over 5 years, 60-40 global portfolio gave you 7.2% annualized return. If you had taken 0.5% from stocks, 0.5% from bonds, put 1% into Bitcoin, you went from 7.2 to 9.2. So 200 basis point upside. If it had gone to 0, you would have lost 20 basis points, 7.2 to 7. So you have a 10 to 1 upside to downside, which is what we're talking about. And by the way, in the worst case scenario where you lose it all, that means you lost 1% of your assets. Right? Which nobody wants to lose money, but you've contained the risk. And so I think that that's part of this as well. Is what scares me personally is I see folks on Twitter who are like, look, I'm 100%. Right? And what I always say to somebody when they ask, is that a good allocation? I say it's impossible to answer that question, right? Because guess what? For a 16-year-old kid who's got $100, earning 3% or 2% on bonds is probably not going to get it done, right? And so it's such a small amount of money compared to their earning power. That's a very different conversation.
He's not spending it on stocks and bonds anyway. He's spending it on his girlfriend or on video games or.
Of course, right? And so it's I use that as an egregious example, but when you start to look at the 25-year-old who's got, a decent job, but their first job out of school, they don't have any wealth saved up, but they also don't have a lot of expenses, has a very different risk return profile that they're targeting than, the 50-year-old who's got 3 kids that are in college right now, right? High expense ratio, et cetera. And so I think that's the mentality and the education around these investors, to me, has been the most shocking thing coming from more of the tech industry into finance. It just blows me away how not even uneducated, just unexposed to what the wealthiest people in the world do.
Yeah, it's fascinating. It's really more about psychology than the algebra, and understanding that psychology and getting people comfortable with taking the right amount of risk, and then that whole conversation goes away from science more towards the art. The more wealthy they get, because at a certain point they can take more risk because they have enough wealth, and they can risk more because it doesn't matter to their life or not. So it's just a really fascinating, nuanced conversation that is part of why I get paid.
Yeah. Well, I'll give you one more that I didn't understand this, but there's a young kid that I know who basically I talk to periodically, and he said something to me to the effect of, I spend too much money. Okay. And I said, well, if you want to tell me the numbers. And so he told it to me. And I said, look, you're trying to save $200 extra a month, right? Which to you sounds like it would be that, it would change your lifestyle, essentially. I said, what if I said to you, you got to make $500 extra a month? So rather than try to cap your spending, is it actually easier just to go make $500 more a month, right? And he basically kind of, faltered and I don't know, how am I going to do that? Whatever. I said to him, look, it's not, it's an equation, right? There's inputs and outputs out in this equation. And if you spend more money, then you either got to stop doing that or you got to make more money. And the making more money may actually be easier for you, so you don't have to change your lifestyle. And guess what? If you save $200, you make $500 more, you actually end up with more money by making the $500.
Right.
Right. And so it's kind of trying to expand the mindset from not always just being how do I contract? How do I spend less? And it's, well, sometimes growth can actually get you to where you want to go faster than let me stop spending, let me do this.
For sure.
Right?
Totally.
Which I think a lot of, of investing, that's how these wealthy families think about it, right? How do I grow what I have? And in many cases, if they're good at it, it's better than if they had a job.
For sure. Yeah, they often do make significantly more in their portfolios than they do in their wages.
For sure. How's crypto fit into all this? So you've got these these wealthy families who are doing all kinds of alternative investing, etc. Yeah. And then are you going to them saying, check out crypto, or are they coming to you saying, what the hell is this?
It's both. But for crypto, it was actually not a client coming to me. But I mean, that's another passion point of mine is I sit down with my clients quarterly and I'm like, here's the numbers, blah, blah, blah. What are you invested in right now that isn't in my portfolio that you're super excited about? And every client gets that question every quarter. So there's a lot of inbound deal flow that I get to be curious about.
What's the weirdest one?
Peanut shelling operation in South Carolina.
Like peanut shelling.
Yeah.
So like
guys
taking the peanuts out of the
shell. Farmers got the peanut crops and he's tired of getting jacked around by the shelling co-op and he thinks, screw it, I'm going to go start my own shelling deal. And I'm, I get that. Literally, I got this call from a client who got pitched this deal and I had to start to try to figure out how to get my head wrapped around that.
Was it a good deal?
It was a horrible deal.
It was
a great idea. It was a great idea, but it was a bad structure, which happens all the time. Great ideas get killed by bad structures all the time.
When you say bad structure, explain that a little
more. It's the whole pre-money, post-money valuation. How much the company is being sold. What is it? Is it an equity instrument? Is it a debt instrument? What's the risk that I'm bearing for the capital that I'm laying out? And so parsing through the deal docs and figuring out where you are in the capital stack and how much risk versus how much of the upside. That's what I'm talking about. Structures you can kill a good idea with a bad structure.
Yeah. Well, it goes back to you name the price, I'd name the terms, right? When you're negotiating with somebody, right. Cool, I'll pay $1 billion for your company. I'll pay $1 a day, for the rest of your life. Yeah. Good luck.
But for crypto, it came actually from a friend of mine. We were sitting on his deck, winter's slowly waning away, a warmer early spring day in 2017. He's like, man, you got to take a look at this. And I, he's a kind of a trend guy, trades at the Chicago Board of Trade. So he thinks about the world as a trader.
Ethereum at that time in 2017, if I remember, had gone from like $10 at the start of the year, probably jumped to like 30. So it's like a 3x right around March time frame.
Yeah, so, he's like, I don't know. I just put money in it and it keeps going up. I'm doing it. And I'm like, well, what is it? He goes, I don't know. And I can't, that just doesn't hit my grip. I got to go figure out what it is. So I thought, well, I'll figure that out. I'll spend an hour tonight. It took me forever just to figure out. I mean, there was not really any content online that was readily available to even understand and explain it.
So this is an important point, right? Which is, to somebody who knew nothing about crypto, you don't know where to look. Right? You don't know about the Reddit subreddits. You don't know who to follow on Twitter yet, right? There's no idea that CoinDesk or Cointelegraph, right? These kind of more niche sites exist. What you do is you Google, right?
That's exactly what I did.
And you find,
all kinds of stuff.
The Bloomberg article, right? And I just picked a random one, but talking about something in 2014.
Yes, exactly. I got that article. I know the one you're talking about. Yes.
All right, so you go look at it.
I look at it, and the further in I get, I mean, it's a rabbit hole, man. I got in, and it was, there's no getting out. It just fascinated me to no end. I mean, it is a I remember distinctly. Okay, true confessions. College, my senior year, I was in a class. We had a group project.
Okay.
Will the internet survive and thrive? And
really?
Yeah. And so
Can I
this
ask
is
what year
19,
this is? Okay.
This is 1993 or 94.
Okay. So just when it started to be become known publicly in the
academic
world.
Right. And we did our research and we came back at the end and said, no, there's no way. There's security risk. Yeah, there's security risks. Like, who wants to buy shoes online? I got to go try them on. Like, I'm going to the mall. Like, what? Like, obviously stupid hindsight. And after a few years, and I look back on that, and I'm like, wow, that was really dumb. Like, I missed that one. And I'm like, well, that'll never happen again in my lifetime. And I distinctly remember that moment coming back in my mind when I started to understand what crypto is, because it's exactly that moment again.
Yeah. What was the part that pulled you in? Like, what was so fascinating about it when you started looking at it?
Disintermediating third-party intermediaries from the financial system globally.
Just a small task.
Yeah.
We'll be done by lunch.
Yeah. Yeah.
Got it. And so what did you do initially once you got interested?
Well, and initially I thought, well, this is great. I'll launch a hedge fund. I'll pick coins. Well, then I started doing a little more work, and I realized I don't know how to program open source code. I can barely spell blockchain. Like I don't know cryptography. I couldn't tell you good cryptography from bad cryptography. I don't. These are really deep sciences with really smart people that I'm not. So I didn't want to be a poser. And there are a fair number of poser hedge funds out there that have none of those credentials that are still somehow smart in the space.
Well, in 2017, if you just picked anything, it went up for, it seemed
right.
Like at least, right?
So the next best thing to me was to resurrect the dying animal of fund of funds. In outside crypto, fund of funds is a dying animal. There's no need for it. It served its purpose for a time, but not anymore.
You want to talk about why they're dying?
Well, sure. Fees, access. There's a natural penetration of capital in the arbitrage space that diffuses returns. I mean, the competition, it's a more crowded fishbowl. There's a number of reasons.
So I asked Mark Yusko, one of my partners, they used to have a big fund of funds business.
Yep.
And he basically said the same thing as that's dying business. And I said, why? And he responded, he goes, the internet. What do you mean the internet? And he goes, well, it used to be that people would come to a fund of funds and they would say, hey, I have some money. I'd like to get into, good hedge funds, for example. Yeah. And that fund of funds had relationships, access, right, knew the returns and could pick, etc. He goes, now I Google top performing hedge funds. I see that, Tiger Global is really high performer. I go to their website. I click the contact us page and I get a phone number and I call up and say, hey, I have money. Would you take it? Right.
Yes.
And they sometimes they say yes, sometimes they say no. Right.
That's true.
But in from a mechanism standpoint, I now know who to give it to, and now I just got to make sure that they're willing to take it.
Yeah.
Right?
But with crypto, there is relationship equity. There is access.
It's a repeat of what happened in the other world.
It will run its course and be useless and obsolete sometime in the future as well. But I felt like that's the only way that makes sense for me to do my part in that space, because I'm a capital aggregator. I have clients that have money. People come to me to hear about things like this. So we launched a fund of funds.
Got it. And on the fund of funds side, what are the types of funds that you found most interesting? Is it people who are picking individual liquid tokens? Is it some other strategies?
Yeah. So a couple of really big passion points for me on this, and I hope I remember them all. But like, number one, we are structured mostly as a liquid product. My redemption terms kind of forced me to mostly stay away from VC kinds of deals. Now, that said, even our liquid guys can't help themselves when they come across really enticing VC deals, and we've got side pockets for all of those. So I would even say maybe I'd have to look again. 20 to 30% of the fund ends up going through a VC, side pocket kind of a deal.
For those that don't know, what he's talking about in terms of redemptions, if you're an investor in the fund and you say, "Hey, I want my money back," there's usually pre-agreed to terms. So it may be you can redeem every 30 days, but you've got to leave your capital locked up for a year to start or something.
Right.
And the problem is if you go and take all of the capital in the fund and you invest it in illiquid deals that are going to take 3, 4, 5 years to materialize. If everyone comes and says, hey, give me back my money, but the capital's in illiquid investments, you can't actually give them back the money. So there's a mismatch between the liquidity profiles. But by having a liquid portfolio or exposure to liquid assets, it's much easier to get liquidity, which means that then you can serve back those redemptions when necessary.
Right. So we purposefully went liquid, partly because we feel like the gap between VC and liquidity in crypto is a really compressed time frame compared to traditional VC to begin with. So the alpha that you earn from traditional VC lockups isn't really there in crypto. We think that liquidity comes early enough that you still capture the majority of the beta trade in the liquid markets to begin with. Did I say that right? Does that make sense?
Yeah, absolutely.
Yeah. So that that's our bent, is to be liquid. Number two, we want to be with the smartest herd in the room. So we were talking about this a little bit before. Crypto, in a sense, I feel like has a bit of an insecurity complex and wants to grow itself up and wants to be considered institutional. And so there's a lot of work done to pigeonhole market neutral guys versus coin pickers versus absolute return. There's just that we're trying to do what happens in normal hedge fund investing in crypto to make it appear like it's becoming more grown up. Mm-hmm. And I think that's a mistake. I don't, I think this is this is venture capital meets liquidity. It's capture the beta. It's stay with the smartest guys in the room, and you better let those smart guys adjust as the market shifts. I don't want the exposure in 17 to look like the exposure in 18 or 19 from that guy if he's seeing things differently. Mm-hmm. So I don't want to pigeonhole people. I just want wide mandates with the smartest guys in the room, and I want a very small concentrated number. Most traditional fund of funds, 20, 25 funds, we're in 5 currently, mm-hmm. anywhere from 3 to 7. But beyond that, the utilitarian value of that extra manager, from a statistical analysis standpoint, it's useless.
Yeah. Well, and also in crypto, there's not that many funds in terms of like the denominator. And so therefore, if you just say, hey, some are really good, some are okay, and some are bad, right? The number of in the really good category is just going to be a much smaller number as well. Right?
Very small. We think there's maybe 8 or 9 like world-class funds in the game. And we're in half of them, and the other half we've chosen not to be because they're redundant.
Mm-hmm. Can I get you to name one?
They're on my website, so you can have all of them. So it's Metastable, Multicoin, Hazur, Digital Global, and Block Tower.
All horrible people.
Yeah.
I know all of them, and they're just the worst. I know some of you who are listening, just you guys are so bad that I want to be your friend. No, they're all great, and I think if you look at all of them, they all have nuances to the strategy, but they all have a general thread between what they're looking to invest in, the structure, the stage, etc. Mm-hmm. So it makes a lot of sense.
Yeah.
How do you talk to your clients about it?
Very big picture, long term. I mean, literally every time it's like, look, this is the riskiest thing in your portfolio, right? I mean, first of all, we launched the fund January 18, so it's down, right? They've lost money. Mm-hmm. So we slowly add more capital, but basically we're like, look, this is high risk. It can go to 0, but this is, world-changing technology that if we're even half right, you'll be glad you own this in 10 years.
What's the general sentiment when they're sitting there? They're about 2 years into the trade, right? Depending on when they came in. They're down, but there's not the like mass hysteria probably of like late 2018, December when it was down around $3,000 Bitcoin price,
right.
etc. Like, what's the general sentiment when you talk to the clients you have today? Yeah,
it's interesting because I think that question is it's never really asked. It's never really confronted with my clients because my clients in an hour and a half dinner meeting will spend 5 minutes on crypto, 5 minutes on the RV park, which is going really well, 5 minutes on the biotech strategy, which we're knocking the cover off the ball. As long as I've got a narrative of reasonably differentiated ideas, some of which are working, some of which are not, but all sort of heading in the direction that I promised them we try to go. I have zero.
And that's because of the sizing in the portfolio?
Totally. Yeah, we're not.
If it was 50% of their portfolio, there'd be a lot of questions, right? If it's 1%, then obviously it's a whole different conversation.
Completely.
Yeah. And let's take on a spectrum of your clients, right? So the most sophisticated when it comes to crypto and the least sophisticated. What are the main differences there? Is it just time spent educating it? Is there demographic difference? So younger clients are more inclined to be interested and older clients aren't? Like, what do you see between the big differences between those sophistication levels?
No, that's interesting. It's really just I don't think it's an age thing. Most of my clients probably do tend to be older just because to get money, it takes time to get money. Right? So I can't say that.
That's a lesson for all the 20-year-olds out there, right? who are all like, I want $100 million. It's like, look, very, very few 20-year-olds in the world ever had $100 million, let alone are going to have it in the future.
So right? I don't think there's a correlation on the age issue, or at least in my limited data set, I don't think there is. But I think it's a personality issue. It's really a, some people just don't care, and for whatever reason, they got money and they need somebody to manage it, and they just don't care. They don't care to care. Other people get fascinated by technology. They get there's an element of curiosity that they don't need. They're not challenging me to know. They like to learn new things. And neither one of those is right or wrong.
Yeah. Do you see any of the clients who didn't have financial exposure? They get financial exposure, whether they do it or with you guys, and then you see them lean into kind of paying attention more and learning? Because one of my theories here is like this whole get off zero idea, right? It's like, look, I don't care if you got a penny or you got a lot of money in exposed to any asset, right? It doesn't have to be crypto, just anything. You start paying attention a little bit more than
for
you
sure,
were, right? And I think that most of the wealth managers that I've talked to, et cetera, they're like, look, it's probably been the best thing we can do to get these people to pay attention is 0.5%.
I totally agree. I completely agree. And that's not just a crypto idea. That's every major. We are for full risk on, like embracing risk capital. We are bullish for 10 years on 3 things: biotech, crypto, and workforce housing. If we can go around the country building more RV parks, if we can press into crypto and biotech, we think those are and so. Just getting a little piece of capital in the portfolio, start small, put it in the portfolio. It's a talking point when we get together every quarter. I 100% agree with your thesis.
Why biotech?
Oh, man, this is my latest super exciting idea that I just can hardly contain myself about. It's very much in some ways like crypto.
Okay.
The old school, hang with me as I explain this. The old school biotech IPO was an exit, right? You got an idea in a university. They do a lab rat model. It goes well. They raise a seed round. They get to phase 1, the safety trials. They go well. Phase 2, you go through this process. You're phase 3. The data's not in yet, but it looks promising, and you're at the end of the deal. And it's in the privates. It's in the venture capital world, and they go IPO, and it's a binary outcome. It's either the phase 3 works, the FDA says yes, you turn the revenue stream on and you make a ton of money, or something happens, it doesn't work and it goes to zero and you wasted all that private money. That's the old school biotech IPO. Not today.
Okay, what's the difference?
Today, biotech's going public pre-clinical trials.
Why?
Because they can.
Because there's the ability in the markets, the access to capital.
So you're getting tickers trading on Wall Street that are a lab rat model and an idea. The FDA has not allowed them to go into clinical trials, even for a safety trial yet. Now, you might think, well, that's crazy. That's horrible, risky. Actually, it's the opposite.
Why?
Because there's a lot of companies that go from lab rat model to phase 1. There's a lot of companies that go from phase 1 to phase 2. There's fewer, but many that go from phase 2 to phase 3. Very few companies commercialize, right? So if you're in a bid-ask spread, public market, liquid world, and you come to market and say, guess what? FDA said, yes, we're going into the clinic for phase 1. Guess what? We came out of the clinic. We didn't kill anybody, hurt anybody. We're going to be allowed to dose this in an actual efficacious manner to see if our regimen, our therapeutic regimen works. And there's multiple value creation points along that journey where you can win even if it fails. That were before relegated to a private world. They're now being discovered in public markets.
And so is the argument that you're now sharing the upside from the private market into the public market so more people can participate?
It is that, but it's even more about the fact that that's the backdrop in the context of how it's happening. But Wall Street doesn't know how to deal with that. Wall Street analysts are not venture capital scientists, and you cannot understand the idiosyncrasies of these deals without having venture capital science. So what the aha moment is, and venture capital scientists don't want to be on an analyst desk making a Wall Street analyst earning, right? They want to be going and creating companies. So there's this natural bifurcation of those two worlds. Well, if you find a bridge, if you find access to solid VC science who can look at those public tickers and say, yeah, this is massively undervalued. I mean, they've been in the clinic now for 4 months. They're due to report phase 1 in 3 months, and if they haven't reported anything, they're required to report negative adverse events if they happen They haven't reported any. The chances that the phase 1 turns out thumbs up get better every day. There isn't an adverse. Things like that don't get well understood.
Yeah.
And so the bottom line is we just figured this out over the last six to 8 months, and I launched a liquid biotech strategy tapping into this VC research on October 4th, and it's just stupid money. Yeah, it's really good.
Yeah, the part to me that's really interesting is you're seeing it in biotech like you just described. Crypto allowed better access to capital for innovators, and I think that this trend across the board is going to continue as just there's this pent up demand in people want access to what used to be private investments that at some point kind of the dam breaks.
It's the only place, biotech is the only place where I'm not an alpha hater. I actually think right now there's an arbitrage, there's a reproducible model where alpha actually matters. There's a corner of the liquid stock market in biotech, in these really small cap biotechs, where it's completely unorganized. The market is anything but efficient, and real understanding of this venture capital science involved gives you a massive alpha trade.
Access to information.
Yeah.
Right. Before we wrap up, what do you think your clients are kind of headed to over the next 2 years when it comes to crypto? Is it more of the same? Do you think that more of them lean in? Are there things that happen in the crypto industry that you think touch other parts of their portfolio? Like how do you think about, I got a set of clients, here's the profile that they are, there's this thing crypto. Like how do those two things interact moving forward?
Yeah, so you're asking do I anticipate scaling my allocation higher? Would you say is that
so you could scale it higher, you could scale it lower. There could be the introduction of hey, we want to start taking parts of their cash position and holding it in stable coins. There could be tokenization of real estate or stocks. I mean, there's a whole bunch of stuff that could happen here. Like, so how do you think about that?
I got you. So in the 2-year time frame, I would say probably will stay put. I really am pitching this as a 10-year idea. I don't know. I mean, it could be in 2 years. 2 years from now, it could be that everybody in the world understands that crypto is the new thing, and it's already 10x. I don't know that.
We'll see.
I'm not actually counting on that. I think there's going to be an inflection point moment at some point in the next 5 or 10 years. I just don't know when. And I wouldn't want to say that I think it's going to be inside 2 years. So with that risk reward profile, we have the bet where we want it. We're as I gain new clients organically, we'll add capital to the fund through new relationships. But the allocation, 2 to 5% model is really where it needs to be. Now, if we're lucky and it does go 20x in 2 years, totally different game. And I don't even know what we would do at that point, because the trade could get better from there.
So one of my questions is always, let's say you have 2%, right? All your clients are at 2%. And you see a 10x. So now 20% of client assets. Do you rebalance or do you keep it?
I'm not sure.
It's probably a good answer, right? Is you need more data to understand where you are in the market, et cetera.
Right.
But it's very interesting because when you have the asymmetric assets, you could go from it was 2%, now it's 10, 20%.
So like number one, I'm not ever going to be the actual capital manager. It will be through my managers. I don't want to have to make a choice on a coin. I don't have the skills for it. So this is always going to be a manage the smartest manager kind of mentality. But if we get a 10x run up from here and it looks like 17, where there's no killer app, it's speculation. I hope that we can have the wisdom to think about how to protect that. If it's the opposite, and Fidelity and Schwab and all of these gargantuan monolithic financial beasts that run our world today adapt it and adopt it. There are many killer apps, and the industry it's not a speculative bubble. It's actually an EBITDA measured bubble, if you will.
I never heard that. I like that. EBITDA measured bubble. Yeah, but it's a different conversation, right?
Totally.
And kind of what you do there.
Yeah,
absolutely. Are there any companies in crypto that really stand out? You named some of the funds that you like, but any companies that you just think done a really good job?
Oh, I probably don't have much on that. I mean, I'll tell you that we have an allocation to NVIDIA.
And that's for the crypto exposure through like the GPUs or just computation in general.
Both.
It's interesting, both.
Yeah, we think that, and it's a small allocation, not in the fund, of course, just in the portfolio. We think that space has multiple ways to win over long. Obviously, you're embracing, risk on that trade as well. But beyond that, I am not. I'm generally not a stock picker. I'm not a technical.
Yeah. It was interesting. It's an interesting way to think about the crypto industry, right? In the sense of taking a look at, okay, there's public stocks that are available.
Yeah.
What are the ones that have exposure? Most of the quote unquote blockchain public stocks actually that's not their DNA, right? They kind of backed into it. They changed their name. They did all kinds of crazy stuff. But somebody like an NVIDIA that is supplying, the picks and shovels.
Picks and shovels, yeah.
Right?
We think it's the classic picks and shovels idea.
Yeah.
But I'm not recommending the stock. I haven't even looked. I don't even know where it's trading today. So,
what is the best book you've ever read? The most important book.
See, I did my research, and I knew you were going to ask. See, I've got these notes. All
right, let's see your notes. You at least you came in here without paper. I'm not going to call the person who walked in here one time with 6 pages of notes, and I made them throw them in the trash and not look at them.
No, I love to read. I didn't used to, but do
you read or you listen?
No, I'm an audible guy because I can go, and I like to work out. So like it kills two birds with one stone. I can go 1.5 speed, crunch through a lot of material. And
can you run and listen to the audiobook?
Oh yeah.
Can you lift and listen to the audiobook?
Yeah.
All right, you're like I am. I do the same thing. I don't listen to music anymore at the gym.
I don't either. That used to be but it really doesn't do me much good. Anyways.
What do you do at the gym?
Like for a workout?
Workout.
Oh yeah, I'm like I'm a every other day, chest, back, tri, bi, shoulder, core. So it's a full body except lower body. And then on the opposite days, in the summer it's 4-mile run. In the winter it's a 30-minute 10-mile bike.
Okay, that's like a real workout.
It gets me sweating.
Yeah, it takes like an hour.
Yeah.
It's I'm gonna start asking people what they do for workouts because some people come in here and I'm like, person they worked out. I don't think they're working out very much. You actually look like you work out, but I'm gonna start calling bullshit on some
sanity.
people.
It's a sanity check for me. I can't.
So you go 7 days a week, or you do 6?
No, I'm getting older. I'm 48, and every week and a half I have to take an extra day off.
Yeah. It's do you do anything diet wise?
Yeah, I'm not. So I like to think about it in terms of just a lifestyle habit.
Okay.
So it's really not a binge thing. It's a very low to no carb, 1.5 meal a day, like high protein. I had chicken salad before I showed up here.
Okay.
That's all I've had to eat, just a little bit of chicken salad today, and I'll have a reasonable dinner, but low to no carb. So high protein, a simple carb, no breads and sugars, but complex carbs, vegetables, tons of those.
Got it. So just really staying away from, I'm assuming, sugars and the breads, and then if you can eat protein stuff. Yeah. It's interesting because I was recently looking at if you take 2 diets that are on the opposite end of the spectrum. So you take the like vegetarian, vegan, whatever variation you want, and then you take like the keto, right? Both of them are optimizing for quote unquote health. But if you actually read into what type of health they're optimizing for, one is optimizing for what I would consider more short to medium term health, and the other, one of the proposed benefits of the vegetarian diet is longevity.
Yeah.
Right. And so it really becomes this thing of there's no silver bullet. Right.
Yeah.
There's different diets for different people. It also matters what physical exercise you're doing. Are you trying to build mass, lose weight? All these different things.
You just gotta start listening to your body. The older I get, the more I listen to my body. I used to just bludgeon my body with workouts, and I can't do that as much anymore. But it's kind of a interesting, fun little hobby to tweak it as you get older. But
yeah.
But on your book deal,
all right.
I actually have some thought about this because I knew that was one of the questions that you like to ask.
If you come up with a bad suggestion, you're gonna get absolutely destroyed on Twitter now that you thought about it.
No, I mean, so I read books really for mostly like 3 different purposes.
Okay.
Right. So I don't read to get smarter. I mean, I do other things to get smarter.
All right. Explain
I don't really think that. I'm a skeptic. I'm very my natural come from is to be a linear thinker.
Okay.
I feel like I'm pretty decent at that. What I need to do is I need to be challenged at learning how to dream better.
Okay.
I need to be able to, I need to have an imagination. I did a very poor job of managing money for clients early in my career because I was the world's consummate skeptic. I could pick apart any deal and tell you 100 reasons why it was the worst deal in the world. That doesn't really help people, right? So I had to learn how to get imagination. So I read to be inspired. I read to,
So more nonfiction, I'm assuming.
Totally nonfiction, but the truth is stranger than fiction. I love the biographies that are just crazy stories. And it could have to do with anything, but if it's a true story and it's inspiring, I like it.
What are the best ones?
Oh, there's a ton of them.
Give me one, I'll give you one. Let's see who runs out.
All right,
first.
I'll give you two. The Immortal Life of Henrietta Lacks.
Okay.
Heard that?
I have not. I haven't read it, but I'll put that on the list.
So she is a girl who lived in the 30s or 40s. Without giving a punchline, there are more living cells of her body alive today than there were when she was alive. And HELAX is the backbone of every scientific experiment that's done.
Interesting.
It's a crazy story. The Immortal Life of Henrietta Lacks.
Henrietta, okay. Sam Zell, Am I Being Too Subtle?
Okay.
He basically he was all in real estate, and
Yeah.
one day said, "I'm probably over-indexed. I should diversify. So I'm gonna take 50%. I'm gonna go put it in taking companies public." And then all of a sudden he saw a REIT for the first time. He said, "Wait a minute. I am an expert in real estate. I'm an expert in taking companies public. I should do that." And next thing you know, he built the $40 billion largest REIT in the world and sold it to Blackstone, who, I'm going to cheat and say two books. Steve Schwartzman just wrote a book. And in his book, it's called What It Takes. He describes when he starts what became Blackstone. They ran an ad in the Wall Street Journal and thought all these people were going to call. Nobody calls other than to say congratulations on your new company. And he's like, "Why don't you give me some business?" Like, we'll consider you for later. Gets a knock at the door, and there's a guy with a motorcycle helmet. And he thought he was the food delivery guy. He's like, "I knew who this guy was." And the guy says, "I'm here to talk to Steve Schwartzman." He goes, "That's me. Who are you?" He goes, "My sister said I should come see you." And literally had his bike chained up outside, the way the story goes. And guy in the motorcycle helmet walks in, and there's no furniture, so they're supposed to be sitting on the ground. And they just talk for a couple hours. And that's how Steve Schwartzman met Sam Zell.
Oh, that is fascinating. What's the name of that book?
What It Takes by Steve Schwartzman.
Yeah, I need to read those.
30 years later, Blackstone bought Sam Zell's REIT. And so it's interesting how the world turns. All right, what's your next one?
Red Notice. That's a classic.
Oh, man, I love that one.
Love that book.
It's up there. It's my top 3 most recommended books over the last couple of years to people because it's unbelievable.
It's totally unbelievable. Dude, I have seen Putin on TV mention this guy's name, and I'm like, that's nuts.
So those that don't know, there's a book called Red Notice. It's about a guy, Bill Browder, who was an American investor who went to Russia, did a bunch of investing. Things turned sour, and if you've ever heard of the Magnitsky Act here in the U.S. that sanctioned a bunch of Russians, he's basically the reason for it. And so it's such a crazy story that I actually saw on Twitter. This is maybe a couple of months ago, whenever it was. He was in Spain, and he got picked up by the Spanish authorities under the Red Notice, right? So Red Notice is basically like a FBI's.
I did not know this.
Whatever. And he's only for a couple hours, and then he got released. But they were kind of just, making sure, whatever. And it was a very stark reminder of the book's interesting, right? The book is educational, and it's entertaining and all that stuff. It's real life for this guy.
Yeah,
right.
That's crazy. Just finished Tara Westover's book, Educated.
Oh, you're the second person to mention this. Good?
I actually thought it was really good.
Really?
Really good.
Okay.
Highly unusual.
Did you read, oh man, I'm going to forget, Ashley Vance's book. Is it Ashley Vance? Yeah, Ashley Vance, the book about people in West Virginia?
Mm-mm.
All right. Tell me another one. I'm going to find this book for you before we end up.
Man, so completely different, not quite as inspiring, but the closest that I get to trying to read for being smart. I did read House of Morgan. I read, there's a new Churchill biography out. These are both massive 50-hour books.
Yep.
But I like, historical, these are things where you basically deal with the financial system in this country for 150 years, and you see generation after generation of people dealing with stuff that we're probably going to deal with again at some point, and it's just an interesting context. I think it's helpful just to have some background of
context.
Yeah.
The book's called Hillbilly Elegy.
Oh, I did read that one.
Yeah.
Really
good.
Yeah.
All right, so I got one last suggestion, then we'll talk about aliens.
Sure.
We so it's not a book, it's a documentary. Have you seen The Men Who Built America?
No.
Oh man, if you like House of Morgan and stuff, you got to go watch this. So it was on television when it first came out. You can now either buy it or you can even, I think it's on like YouTube, you can kind of patch together the different sections. It is an 8-part series from the History Channel, and it starts with I think the first one it starts with is Carnegie, then it has Rockefeller, J.P. Morgan, and it's got like 2 or 3 others. I forget. Edison's in there, Tesla, etc. And it basically goes through the story of essentially the Industrial Revolution and what each one of those players was doing and kind of how America got built. And you find, like, I'll give you one detail that I didn't know, and now having watched it, just here to my brain. So John Rockefeller was looking for oil. Very quickly realized, rather than me be the guy, the idiot poking the ground for the oil, why don't I just become the refiner? Because then I can make sure I have a more sustainable business. And then he struck a deal. I think it was with maybe it was Vanderbilt. I think he struck a deal with and said, "Hey, I will give you access to my oil so that you can put it on your rail cars, and now you have a business, right? Because you're going to have all of my oil." And at some point along the way, they basically start to, twist his arm and say, "Hey, well, you need our rails to get your oil anywhere," and so they say, "You're going to pay us more." And at some point, there's basically a lockout where they say you can't use our rails anymore unless you do what we want you to do. And so he, as a very creative and ambitious person, says, "Well, what if I just created pipes?" And then he created the oil pipes.
Seriously.
And so the way that
it
was out of necessity, right? The innovation came from necessity of he no longer could put his oil in barrels on rail cars. And so instead what he did was he said, well, I'll just build oil pipes and I will literally pump it or take it from the refineries, push it through these pipes, and I'll get it to where it needs to go. And now basically you lost my business and you can't stop me.
That's really fascinating.
And so there's example after example. As you start to realize this, there's a reason why J.P. Morgan's a big name, right? Yeah. Rockefeller's a big name. They did a lot of stuff that was pretty innovative.
That's the antithesis of that skepticism I was telling you about trying to grow out of personally. So.
Well, the Men Who Built America. All right, aliens, real or not?
This one is another one that I knew you might ask. I have kind of maybe a backward answer for you.
Okay.
I actually think the entire question is a backdoor question to your view of the world.
Of course. I've said it many times. The reason why I ask the question is it tells you how people think.
Yeah. Meaning, is there intelligent design or not?
Okay. What do you think?
So origins of the universe type of deal. Because if your answers are going to naturally bifurcate coming down, or you would think your answers would naturally bifurcate coming down that. So I'm in the intelligent design camp. I'm in the traditional Judeo-Christian view of the world.
Yep.
So that would naturally probably put me in the camp that says, no, they can't exist. But I'm actually not there. I would say, in the natural Judeo-Christian view of the world, the pinnacle of creation is man, which would mean that to have other life forms evolve ahead of us wouldn't really necessarily coexist. And I would actually subscribe to that. But I mean, the universe is a big place. So there's no reason why God could not have superintended an evolutionary process to culminate with man and have aliens on 5 million planets in the universe.
I got a stat for you for the next time you're at the trivia night at the local bar. How many planets are there out there for every grain of sand on Earth?
Wow.
How many planets per grain of sand?
In the universe?
Mm-hmm.
Well, clearly it's more than a 1-to-1 ratio. I have no idea.
10,000.
10,000 to 1.
10,000 planets for every grain of sand on Earth.
Yeah. So
that scares the shit out of me.
It is. It's a fairly myopic view. First of all, it's fairly myopic. It's actually normal for Judeo-Christian worldview people to be myopic in their thinking, but the facts are it's fairly myopic to think that we're it.
Yeah. So that stat comes from there's a new Netflix Explained series on. They don't use the word aliens because that's too taboo. So they use like artificial, or extraterrestrial life or whatever terminology they use. But that was in there. And then the other thing is I read right now there are 2 galaxies that are colliding, and we are going to hit them in like 2 or 4 billion years. And I'm out, man. I shut my computer. I got to go do something else.
Over. Yeah, it's interesting stuff.
Because I also saw there's meteors right now coming towards Earth, and this is supposed to be one of these that like, hey, we should be paying attention to, yada yada, whatever. And I was looking and I said, look, whether they're right or not, we have no way to check.
We don't. Well, see, that's my. Either way, if you're atheist, you're agnostic, you're Christian, you're Hindu, you're Buddhist, ultimately it comes down to not science. Nobody's there to observe how this stuff happens. So you're a man of faith, whether you're a man of faith believing in Jesus or in the fact that there is no God. Mm-hmm. One or the other. Either way.
It's a great way to look at the world. What one question you have for me to finish this up?
What is the most exciting, interesting, non-crypto investment that you are stoked about, like right now, that you cannot?
That we've done?
No, that you're into. That you're like, right now, I'm not going to cover off the ball. This is the coolest thing. Maybe there's nothing.
I don't want to say the name of the company because I don't know what they're comfortable with me saying or not. But there's a couple of ways to answer this. So, first, somebody said to me, this guy Bruce Fenton, who came on, he's an ancient alien researcher. Which, love you, Bruce, but I'm only 80% of the way there with you. And he said, look, every human has 2 questions. The first is, are we alone? Right? Meaning, is there extraterrestrial life? And 2 is, what happens when we die? Right? And every human at some point in their life will think of those 2 things. I believe that here on Earth, answering one of those 2 questions would be one of the greatest, achievements in life.
Sure.
Right. Now, I don't think that somebody's going to say what happens after we die. Right. It's just conceptually would be very difficult to do. Along those lines, though, we invested in a business that scientifically has figured out how to freeze your brain. And what I mean by that is it essentially, in a very overgeneralized, non-scientific way, delivers cryogenic freezing technology to your brain at the point of death. So as you're dying, pushes this in there through this oxygenated process, freezes your brain with 100% structural integrity. By doing that, what the belief is that they can actually freeze your synapse connections. What exists in those electrical connections? Experiences, knowledge, right? Emotions, all this kind of stuff. So if I can basically salvage and preserve emotions, the consciousness, all this kind of stuff, can I then take it and upload it to a computer? And so therefore, imagine if we had Thomas Edison's brain and we could feed it new problems, right? So not so much in the, there's some people who say, oh, this technology would be great because when I come back, right? So there's that kind of,
right.
More sci-fi stuff.
Right.
There's some people who just say, hey, look, by being able to do this, we can do research, right? So there's kind of, directly applicable science, or this kind of middle ground of, okay, I'm not there yet on like humans come back, right? And I'm not there on like I can cryogenically freeze you and then revive you later. But I do see this world where I could essentially take what's in your head, put it into a computer, and then I can't necessarily evolve it from there, but I can feed new problems to it and use the frameworks, mindset, all this kind of stuff that you have. To me, I don't know if that's the right answer, but this combination of taking human brain and intelligence and combining it with computational power. I think a lot of people are thinking about it. How do I take the computer and put it into the brain?
Yeah.
Right. And augment it that way.
And you're doing the opposite.
This company's doing it opposite, but just like either direction, I think is super interesting, because you could say, how cool would it be if I don't have, I had to look up Hillbilly Elegy, the book, right?
Yeah.
Well, if I had a chip in my brain, I could just immediately tell you the big inflection point in human history.
Well,
right?
That's cool. The common thread is, the Human Genome Project, I think, is nearly 20 years old now. And the order of magnitude that mapping has done in clinical trials is breathtaking over the last 20 years, but it's an asymptotic curve into the future. The next 20 years are going to be by an order of magnitude larger than the last in terms of the scientific advances that we can do in the human body based on our understanding of the human genome and our ability to construct trials accordingly. It's one of the reasons why we're massively bullish biotech in general.
Yeah, it's we know more about the surface of Mars, I think, than we know about our own oceans, right? Yeah. There's same thing could be said about the human body. We know a lot. Yeah. We don't know nearly as much as we probably should. So a lot of work to cut out. All right, listen, this is one of the longer ones I've done in a while, so I appreciate it. This is the longer we go, the weirder it gets. So if you're still listening, you're a trooper. Actually, if you're still listening, the first 3 people to tweet at me with the words "aliens are at the end of the podcast," I'll send you something special to see who made it all the way here. But thank you so much for coming to do this, and we're gonna have to do this again. Maybe I'll come do it in Chicago.
Oh, that'd be fun. It'll be blessed. I appreciate it. Thanks for having me. It was a lot of fun.
For sure.